We are live streaming on YouTube. Welcome to our Real Estate Investment 101 webinar. I am Shannon Jones with Keller Williams Realty in Long Beach. And with me tonight, I have Brad Jones as well, who is my husband and business partner. And we have Shalyse Kendrick on our team, who is a certified real estate investment specialist. We also have Matt Cady, who is a lender at Summit Lending, and Kevin Kelly at Orange Coast Title. So we're going to review what you need to know if you'd like to buy an investment property. Let's get started.
So when you're thinking about buying an investment property, you'll want to think about the different types of properties available. There are three. The first is residential, which includes any property used for living with 1 through 4 units. And then there's commercial, which can be a property used for living with 5 or more units, or something with a commercial element like a warehouse or office space. And then there's mixed use, which is a combination of the two. So think a building with apartments on the second floor and retail at the bottom floor. For the purpose of this webinar, though, we are going to focus on residential investment properties because that's our specialty, and a lot of people consider it a much easier way to break into real estate investing. Now, when you're considering an investment property, one thing you want to think about is what plan do you have for that property? Do you have a short-term goal to simply generate a cash flow, or a long-term goal to simply build wealth? And a lot of investors employ one of a few different strategies. The first one being a buy and hold long-term strategy, where they simply buy the property and they never sell it. They take advantage of long-term equity growth and appreciation. Another method is the buy and sell or flip, if some of you might know about. They purchase a property, rehab, improve, and end up selling it for a profit. They may utilize a 1031 exchange to step up into another property, and we'll go over that later on in the webinar. Another method is the BRRR, buy, rehab, rent, refinance, and sometimes there's a fourth R for a repeat of the whole process, also stepping up into another property. And there are pros and cons of each strategy. And it's going to depend on your overall financial strategy, which one would work with you. And we'd be happy to go over each one of these in detail if you'd like to schedule a time to go over your plans with us.
Great.
So what you need to know before buying an investment property, there's a lot of things to consider, but mainly the first one is your down payment requirements. What type of down payment is needed for a property? A lot of people purchase their first investment property as their primary residence, and then use that to leverage into additional investment properties. And the reason they do that is because when you purchase a property as your primary residence, you might be able to buy it with as little as 3 to 3.5% down. Compare that to a strictly investment property or non-owner occupied, that down payment is going to be significantly higher. And Matt Cady here is going to go through financing and different loan types available and what type of down payments needed. So when you buy a first time, an investment property that you'll live in, the out-of-pocket cost can be significantly lower. Speaking of out-of-pocket cost, your rehab cost is something you also want to consider. How much money do you have available to renovate the property? If you are limited in the cash that you have, you might want to consider purchasing a property that is closer to being ready to rent. Also, resources available to you. Not only do you have to consider the money that you have as a resource, but also the available help. Any contractors, if you have contractors available that you can rely on, then a renovation might be more accessible to you. Then you'll want to consider the geographical location. That's super important. You'll want to know the market that you're purchasing in, what the projected growth is, the demand for rents, and also, what people are paying for those type of properties. Being that we're in Southern California, we have a lot of clients who decide to invest in other geographic areas just because the price points can be significantly lower than they are here. If that's something that you're considering doing or would like to learn more about or explore, we have a number of connections in other areas that can help you. So let us know. And then finally, you want to think about the criteria for the property. What type of property are you looking for? What is the bedroom count that you'd like, the area that you'd like to buy in, and what type of metrics would you like to see out of this property? And there's a number of methods you can use to compare and contrast different type of properties. And you'll want to be familiar with them so that you can feel confident in moving forward with an investment property purchase. Brad's going to go through some of the metrics too. Metrics. And why you should invest in 2024 is because real estate appreciates, and there might be some ebbs and flows, but overall it appreciates. In fact, February last year to this year, real estate has appreciated 5%. And depending on who you listen to, it's anticipated that it will grow anywhere from 1.9% to 5% in the next year. Also, rental demand is also increasing. The prices for rents are increasing, and they're anticipating to continue to increase. Lately, there's been a slight lull, but rents always go up. And because housing is necessary, there's a level of resilience that real estate has that some other investments don't have, or not as well. So real estate is a little more resilient than other industries. Also, owning real estate, you may be benefiting from some tax benefits. Finally, real estate's a tangible asset. You can see it, you can maintain it, and make improvements to it directly, and it's fun. You can also diversify your portfolio with real estate.
And one thing I'll comment here is location that we mentioned on the previous slide, a tangible asset. A lot of times people want to be able to go to their first investment property. So purchasing something within a reasonable driving distance of where you live can be a real advantage. Might give you a little comfort level. You can just drive by the house and check up on it. You're not relying on some third party in an out of area location. Still an option, but just something to think about.
One thing to comment when we are talking about different geographic locations is what we've found is that some of our clients who choose to invest elsewhere have a connection to the location that they select. So it could be that they maybe used to live there, or they have family members who are there. And that gives them, some reason to potentially go there occasionally. And B, somebody who may be able to be their feet on the ground and actually drive by occasionally and take a look at the property, if not actively managing it. So that's just something to keep in mind if you are thinking about investments elsewhere. And as Shalyse said, we have some amazing connections with top agents around the country and in fact, around the world. So just keep that in mind. Okay.
Okay. So here's some investment terms to just be aware of. I'm not going to go into details on the numbers. The numbers will vary depending on location and types of property. But these are things that you might hear about as you're looking at investment properties. What do you look at? How do you compare one to another? The net operating income is really just the total revenue that the property generates, less the expenses, not including your mortgage or your taxes, but the expenses. So it's a way to evaluate what that property is generating. Cap rate. Cap rate is a calculation that a lot of experienced investors use because how do you compare a duplex to a fourplex? How do you know which is a better investment? The fourplex has different numbers, but it might be higher numbers, but they might not be the return that you're looking for. So a cap rate is really the operating income divided by the property value. And what do you want to know there? The rate of return on your investment, a higher cap rate is a little better. And what that number is, again, varies by location quite significantly. The gross rent multiplier is kind of a less effective cap rate, if you will. It's a way to just very quickly determine what the return is on that property. So a gross rent multiplier is telling you how many years of income would it take to pay for that property? How many years of income rent income would cover the purchase price? And here, a lower number is better. Obviously, the lower number of years it takes to cover that price, the better it is. Southern California numbers, again, in Long Beach, we might be at about a 5% or so cap rate and maybe a 14 or 15 gross rent multiplier. But again, those are ideal numbers, or those are the actual numbers. Numbers in different areas will vary. The operating expense ratio is a little bit more, operational, if you will. It's the expenses over the operating income. Obviously, lower expenses is better, but you are going to have expenses. You are going to have to set aside money to maintain your property. There's going to be regular maintenance, hot water heaters go out, things like that. You need to set aside money to operate your property. Cash flow is really just the income less your expenses. And it all comes down to the return on your investment. How do you compare a real estate investment to a mutual fund or a stock? What kind of return? How much money are you putting in versus how much money are you getting out?
Message from Brandy Zamora.
And the ROI is how you compare not a real estate investment versus a real estate investment, but any investment. What return am I getting? And again, going back to Shalyse's topic earlier, portfolio diversification is important. Your return on real estate might be a little different than your return on stocks. And the risk is different. Again, talk to your realtor like us, talk to your financial advisor, determine what's best for you.
Oops, hold on. Sorry, Kevin, I muted you for a minute.
Okay.
Now you're unmuted.
Okay.
Kind of one of those arcs, right? The
Okay.
arc of investment. When most of us started buying rental properties, we wanted appreciation. Now, as you reach a certain age and the appreciation has been great, now it may be time to diversify and make it more cash flow liquid, right? The appreciation is as important as monthly payments. That's the great part about real estate. You can change that dynamic at any time as your life unfolds.
And maybe when you're a little younger, you don't need that income,
right?
But the price appreciation is great. And then as you get older, you can utilize your income property as cash flow to help supplement your retirement. So again,
or cash it out. And I mean, we have clients who have investment properties that they then convert later to primary residences and then cash that out and use it to fund retirement. So again, I think that what is your strategy? It goes back to establishing at the outset, what are your short-term goals? What are your long-term goals? And based on that, what are the type of properties we should be considering?
Right. And then how do you buy it? How do you finance your investment? There's residential financing, which is a lot different than commercial financing. We work in the residential market. Matt works in the residential market, the 1 to 4 unit properties. And that's what Matt is going to go over. How do you find a lender? Well, you ask a realtor like ourselves and would refer you to somebody great like Matt who can go over all of this information. So
And just as an aside, if what you are interested in instead is 5+ units or commercial or mixed use, that is not something that we specialize in, but we do have partners who we work with and certainly could also refer you to somebody who could help with the financing. But again, today we're focusing on residential investments. So without further ado, Matt, Cady.
And I was putting together some programs to discuss in this slide, and it's all under the spirit of people getting started with real estate investing. And as I go through it, you'll notice that there are some of these loan products will say owner occupied. And when we think about owner occupied, a lot of people are like, how do if I want to get started building a real estate portfolio, maybe the first house that I buy is not my ideal dream house, forever house. It is a stepping stone to the next one, and I can retain it as a rental and buy the next property. And a common way that people do that is using an FHA loan. So an FHA loan will allow for a 3.5% down payment. It will technically lend up to 4 units. However, if the property is a 3 or a 4 unit property, it has what's called a self-sufficiency test. And a lot of properties don't pass the self-sufficiency test. So the real sweet spot for FHA financing is either a single family or a duplex because of those reasons. So you would buy it, put a low down payment. Let's just say that it's a duplex. You get a tenant put in, and you're on site. I mean, I think for somebody's first investment property, Brad mentioned being where you could drive to it. Even better if you're living on the premises and you're closely monitoring the property. FHA it's a great way to do that. One thing that changed last year for the better on conventional. So conventional used to require a 25% down payment for doing 2 to 4 units, and they changed it to a 5% down. So a conventional loan is perfect if somebody wants a lower down payment. They want to buy 3 or 4 units and they're not going to buy because of FHA's rules with the self-sufficiency test. The conventional loan is fantastic. And if I could, with my wisdom now, if I could go and talk to a younger version of me, and if we had the conventional 5% down, I would really, that's something that really appeals to me. I mean, if you were to buy 4 units, if you live in the property, you make all the small improvements and repairs while you're living there. You get all of your tenants lined up perfectly well. Hopefully you refinance, drop the payment that helps your cash flow later on. And once it's really cash flow positive, then you move out and you buy the single family that you dreamed of. And if you own 2 properties and you have 4 tenants, what does your financial life look like 15 years from now, both from an equity position and a cash flow position, right?
I think this is a really missed opportunity because I think what happens is a lot of first-time home buyers get in their mind that they want to buy a house. And then when they can't buy a house, they maybe look at condos and then they just decide not to move forward because they don't want to buy a condo and interest rates are too high. And they are just focused on not being able to achieve what they want now. And when you say that, I wish I could talk to that younger version of myself. I feel like I just want to tell all those people out there who are starting out, Like, don't worry about buying your dream home right now. Let's go out and find you an awesome 2 to 4 unit property that you can get into with what you've got now and have somebody else pay your mortgage. And then later, when you've got the equity, you can leverage that to go out and buy the home you wish you could buy now. Like, I just want to tell people that.
Everyone should look at their first house as their first rental,
Mhm.
not as their dream house, right?
Well said. Yeah.
Mhm.
I mean, imagine, let's just say hypothetically that somebody was engaged. If you weren't going to live together for a period of time, if you had two people that each did 5% down and bought 4 units, and then a year later got married and then bought a single family house, they'd have 8 tenants paying them rent and they'd own 3 properties. I mean, like, that's probably a good enough retirement. Talk to your financial advisor in and of itself, right? So
Mhm.
I'm a huge fan of that option. For somebody that already owns their primary house and they're in their dream house that has the great backyard and the pool, then they're looking at non-owner occupied financing. And that's where the down payment is increased. So if you bought a single family house as an investment property, your minimum down payment is 15%. I would advise 20% down because the terms are much better than 15. But if you found a just steal of a deal for a property and you wanted the lowest down payment, you could do 15% down on a single family. And then if you look to do the 2 to 4 units, then you need a 25% down payment. That's how an investment property or non-owner occupied loan works. People talk a lot about like what is needed to qualify. All of these first options are based upon debt ratio. So it simply is how much monthly expenses do you have versus what is your gross income. And debt ratios are traditionally in that 45 to 50% range. FHA will allow for what they call a back end ratio, including like credit cards up to like 57%. So that's why FHA is a really popular option. But a lot of people ask, well, how does the rental income calculate? Can I buy more house or buy something more expensive that's a rental property? And the answer is yes, because we can count 75% of the rental income from the other units as if it was a second job, basically. So it's income that's just added to somebody's qualifying income. And all the documentation are just traditional 2 years of tax returns, W-2s, last 30 days of paycheck stubs, and it can vary if somebody's self-employed.
Okay.
Now, these programs are really more designed around, I don't want to say it's exclusively for people who are self-employed. Some people are W-2'd, but the DSCR program, you'd be surprised how common this option is. So a debt service means that instead of us evaluating the debt to income ratio, we're simply evaluating the cash flow of the property that the person's buying. That's how they qualify for it. So it's non-owner occupied only. You can't use a debt service loan for your primary residence. And it requires a minimum of a 20% down payment. And I know that, Kevin, I know you're going to talk about this a little bit later, but the debt service loan also allows people to hold title and close in an LLC or a corporation or some sort of business entity. And that is what draws some people towards the DSCR loan, even by itself, outside of the debt to income ratio. Another way that we can help people qualify debt to income ratio wise is a bank statement loan. So if you think about somebody who is, now this is strictly for self-employed. Let's just say that somebody's self-employed, they have a ton of business deductions. They actually really make money, but they have a ton of deductions. Traditionally, a lender's going to go off of their tax returns. Well, the bank statement loan allows us to evaluate the last 12 or 24 months of what are the consistent deposits into either their personal or their business account. And we use a percentage based on the type of business it is as income. So a bank statement loan will work in lieu of tax returns that wouldn't work for that person. And it's owner occupied or non-owner occupied. And the minimum down payment, owner occupied, is 15% down. I believe it's 20% if it were an investment property.
Okay. And Matt introduced it a little bit, but Kevin's going to talk a little bit.
Yeah.
Take
So
time.
I get the exciting topic of title, which probably the general public has no idea what it is. So just what I'm gonna kind of be brief about is there are two things that can be affected by how you take title to a property, owner occ or investment. One is taxation and one is survivorship. So if something happens to you, what are the implications for that property and all your properties, or are you separating them out, right? So most standard types of taking title, very similar to owner occ. Joint tenancy in California, that's normally husbands and wives. It can be up to as many people as you want, but everyone has an equal share. If Brad, Shannon, and I own a property together, something happens to me, my third automatically is now half and half. That's kind of how that works. Community property, similar survivorship issues, but you can delineate percentages. We like that, but there's this additional verbiage. When we get into the more real investor kind of situation, people like to have it in entities. And the two most common, LLCs and corporations. The biggest difference being LLCs have members and they tend to be smaller. It's like Shannon, Brad, and I decide to buy a property together and we form an LLC, and then to sell it, all we have to do is agree. We don't, in a corporation, it's much more formal. There are officers, there are more procedures. In most cases, in corporations, there are dual or tri signage requirements. So it's a little more, it's kind of an LLC turned up, right? But the tax advantages are sometimes better. In California, we see this a lot because we are a community property state. So if you acquired properties prior to your marriage, whichever one that is, or you want to keep your assets separate, you can form an LLC that doesn't have to include your spouse because that's not considered community property, the LLC incorporation. So that's kind of the advantage there. It's very specific. So I always say, when you're buying anything, don't check the first box. This is all I do. So it's one text or phone call. You tell me your scenario and we figure out what is best for you. The last thing I am going to say, everyone that has at least one property, but definitely two or more, needs to have a trust. And trusts for $1,500 to $2,000, that we can give you great referrals to people that are local, but it basically is the roadmap for what you would like to have happen to your portfolio of real estate if you are incapacitated or you've passed away. And the great part about trusts is they live on past you. So I pass away, my successor trustee, my child, is now in charge. And then she could amend that trust and have her future children as her successors, and all of the tax benefits that I originally took 100 years ago would still be in that trust. So avoiding taxation, big deal in California. We all feel we are overtaxed.
The other thing with trusts that's so critical is that nobody plans to die or become incapacitated, but it happens to somebody every day. And if you don't make the plans, then you are leaving the mess for the people you leave behind, which requires probate. So just get a trust. And that's a whole nother webinar.
But that's all I got.
Stay tuned. We'll probably do one of those.
If you're interested in that, make sure you're on our email list.
Okay, so thank you, Kevin. And again, if you have any questions whatsoever about title, about any of this, reach out, give us a call. We're happy to put you in touch with Matt or Kevin to answer your questions. And if you do have property, as you're acquiring property, maybe you've had it for a few years, you've had some nice equity growth, and now you're thinking, what can I do with it? How can I use my equity? How can I leverage this into my next property? This is how people accumulate real estate wealth. They can do what's called a 1031 exchange. It's a tax deferred exchange. It allows you to avoid capital gains on the sale as long as you handle it properly. And properly means using an official 1031 exchange accommodating company, accommodator, to handle that exchange. What that means is you don't touch the money. You sell your property, the funds go into an escrow account with the accommodator. You identify and purchase your next property, and the funds go directly from there to your next property.
Well, and Brad, a nice sidelight on this that's changed in the last couple of years is the identification of a viable property. 10 years ago, you sold units, you had to buy units. You sold a building, you had to buy a building. Now, all of those are gone. You can sell units and buy oil and gas leases. You could sell a property and buy a mixed use building. So it really, and you can do it everywhere in the country. So there, it's really advantageous, and it's kind of a nice, it's really expanded a lot of the options.
It allows you to, maybe I have an opportunity to buy a car wash with some people. The accommodation company that we use has some great information, and Kevin's spot on. It just needs to be an income producing property. It needs to be an investment property. It's not your residence.
There
again,
are some timelines that you need to pay attention to when you're doing this. And so that's something definitely we can walk you through in terms of identifying the property and completing the acquisition of the replacement. There's also some variations on this. So we've had people do reverse 1031 exchanges where you find your replacement property first, and then you sell the property that you are replacing. So if you're interested in this, we can definitely get you some more information on it. But we just wanted to make sure that you're aware that it exists as a tool. Because planning for taxes is definitely, or not paying taxes, if you're able to avoid that legally, is definitely something to keep in mind.
we do have an older YouTube video on exactly this topic, and we could update that at some point. But Phil Atwan, our exchange accommodator representative, has a lot of great information. If you want to look back in our YouTube channels, I'm sure you can find that video there.
Absolutely.
And then,
mhm.
Shalyse, we'll let you kind of summarize our webinar for today.
So how to get started if you do want to move forward and purchase your first investment property. The first thing you'll want to do is schedule a consultation with us to help you establish your goals and outline how to get there. Form your team with your real estate agent and your lender, hopefully us, and then you'll get your pre-approval and determine your budget, because those two numbers could be separate numbers. You'll find a location and locate your property.
Sounds great.
Can I double click on just one item there?
Yes.
Yes.
As far as like the get pre-approved and work with an agent, if we're talking about a non-owner occupied house, or if we're talking about a property that's units, it is so important that the realtor and the lender communicate and collaborate together, because I mentioned that we can count 75% of the rental income. Well, if we're dependent on the income to qualify, and if that determines our budget, we need to know, I need to have an understanding of what's a duplex in this area? What's the rent going for? What's the rent going for on a 4-unit property? That way we're calculating that correctly on our side, and we're avoiding having any debt to income ratio issues with the client. Like if we communicate up front, we don't have to have a problematic conversation later on.
That's a really great point, Matt. And one of the things that I want to say is when we start talking to clients, to potential clients about their plans to buy property, what are their goals? What are their priorities? What's their timeline? What are they looking for? We ask a lot of questions up front because we can't help someone meet their goals if we don't know what they are. That is not necessarily the case with every real estate agent. Matt up front will really go over the numbers with a buyer. So again, there aren't any surprises. Surprises in real estate are never good. There just aren't any good surprises. And so part of our job is to try to reduce the possibility that there will be any surprises. And that communication between the client and the realtor and the lender, ideally would be complete open lines of communication, very clear expectations. And what we find in our industry is that there's not all realtors and lenders provide the same level of service. So I'm not saying you need to work with us or you need to work with Matt, although we're certainly happy to help. But when you are choosing a realtor and you are choosing a lender, ask a lot of questions and make sure that you're comfortable with the communication. Check the reviews online because the experience that you'll have will be greatly influenced by who you choose to work with.
Okay.
I'll get off my soapbox now. All right.
And just as a team, the Shannon Jones team, myself, Shannon, Shalyse, we specialize. We're based in Long Beach. We specialize in really South LA, North Orange County. We can go inland a little bit as well. And if we end up going to an area or you're interested in an area that we don't service, Matt could still help you, but we would help you put you in touch with a realtor who specializes in a particular area who might be able to better serve your needs. But we can cover quite a wide range ourselves. So again, just if you have an area you're interested in, ask us. We're happy to.
Yeah, and if we don't feel that we'll be the best agents to help you, then we'll let you know. So I appreciate all of you being here with us tonight. And it looks like we had some participants who joined us and some who maybe didn't make it. But I did tell people up front, if you're not sure if you can make it, do go ahead and register because we will be sending out the recording. So whether you're watching this tonight with us live or you're watching this after the fact, if you have any questions, I'm realizing that our phone number is not on here, but I will make sure that it is in the text below on YouTube. And you can also find us online at showmehome.com. And if you click contact us there, it'll come to us. I will share with you right now our phone number. It is 562-896-2456. We're also on Instagram. We're on Facebook. We're on TikTok and LinkedIn and X, which used to be Twitter. And pretty much if you look for us, you will find us. And we are more than happy to help.
And
so
you'll be able to find Matt the same way.
absolutely. Look for Matt, Summit Lending.
You want to share your phone number real quick?
Yeah.
Best number to reach me is 949-238-6035. We do have a website, Cady Mortgage Team. That is, my name spelling is a little odd for some people. That's MATTCADY mortgageteam.com.
Okay.
Wonderful.
And if you missed that, just give us a call. We'll put you in touch.
All right. Thank you, everyone. I am going to turn off the YouTube live stream app.